Hello from sunny Coral Gables, Florida. A few days ago on March 9th, we marked the 10th anniversary of the bottom of the market's horrible period, which has been called the Great Financial Crisis. A crisis that impacted the world. We saw the U.S. market, as measured by the S&P 500, drop more than 50%. We saw international markets have similar negative numbers. It was a period of distress and deep concern. Valuations for many companies reached levels we hadn't seen since the Great Depression back in the 30s. Investors were emotionally drained and couldn't think straight. However, as we now see, it was the beginning of a recovery that led the major market indices to reach new highs. Investors were able to regain their value and reach even higher valuations. However, two ingredients were needed. You had to stay invested and you needed to be patient. Easier said than done. One of the major lessons of that time was that challenged investors to remain committed to what they had planned to be a long-term investment. Being in the midst of this major drop and not seeing clearly where things were headed made many revisit their investments. Some stuck it out, others decided things were cheap and would invest more, and yet others decided that enough was enough and pulled some or all of their investments from the market, probably at the worst of times. The lesson that both clients and advisors should have learned was that in order to properly endure such a severe challenge to investing for the long term, was that it had to be allocated in a manner that even these dramatic drops would not derail its long-term success. It is imperative and crucial to have a clear understanding of the level to which a person can tolerate volatility or risk. Everyone is different. Another lesson learned from this time period is that diversification does work. Even though the equity markets were suffering severe drops, the fixed income markets were doing quite well. Having had a properly balanced portfolio would have allowed the portfolio to weather these storms better. Additionally, many non-correlated investments such as hedge funds and credit funds did well. And finally, a third lesson that was a result of these challenges was to have an adequate amount of funds set aside so that your lifestyle and the liquidity that you need to live comfortably would not be in jeopardy as a result of these market fluctuations. Making sure that you have set aside a liquid, secure fund that can cover your needs for a year or more is always a good idea. The more you have invested in growth-oriented investments, the longer the time period you need to keep in liquid reserves. I'm sure there were many other lessons, but from a big picture, these were three that stood out for me as an advisor. I truly hope I don't see something like the 2000-2009 period again, but if we do, we will certainly have implemented some of the lessons learned. We remain available to you to discuss how Premia Global Advisors can help you put together a portfolio that represents your individual goals and risk profile, and how our diversified portfolio can help you navigate the challenges we are surely going to experience in the future. Call us, and we'd love to spend some time with you. Thank you very much.